Here's a summary of DHI's Q4 2025 earnings call transcript, designed for clear and concise reading. DR Horton, DHI. Q4 Fiscal 2025 earnings call summary. Good morning, everyone. Today, we'll review DR Horton's performance for the fourth quarter and the full fiscal year 2025. Financial highlights for Q4 2025. Consolidated revenues. $9.7 billion consolidated pretax income, $1.2 billion pretax profit margin, 12.4% net income, $905.3 million, or $3.04 per diluted share. Home sales revenues, $8.5 billion. Homes closed, 23,368. Average closing sales price, $365,600, down 1% sequentially, down 3% year-over-year. Net sales orders increased by 5% year-over-year to 20,078 homes. Order value increased by 3% to $7.3 billion. Cancellation rate, 20%, which is in line with the historical average. Average selling price of net sales orders, $364,900, flat sequentially, down 3% year-over-year. Home sales gross profit margin, 20%, down 180 basis points sequentially. Full fiscal year 2025 performance. Consolidated revenues, $34.3 billion. Consolidated pretax income, $4.7 billion. Pretax profit margin, 13.8%. Net income, $3.6 billion, or $11.57 per diluted share. Homebuilding pretax return on inventory, 20.1% return on equity, 14.6% return on assets, 10% cash flow from operations, $3.4 billion generated. Shareholder returns, $4.8 billion returned through repurchases and dividends. Key operational and financial metrics. DR Horton provided homes to nearly 85,000 individuals and families in fiscal 2025, with over 91,200 households finding a place to call home through their home building and rental operations. The company emphasizes its commitment to affordability and efficient operations. Management's forecasts and outlook for fiscal 2026. Full year fiscal 2026 consolidated revenues expected to be between $33.5 billion and $35 billion. Fiscal 2026 homes closed, home building projected to be between 86,000 and 88,000 homes. Fiscal 2026 income tax rate, approximately 24.5%. Fiscal 2026 cash flow from operations, expected to be at least $3 billion. Fiscal 2026 planned share repurchases, approximately $2.5 billion. Fiscal 2026 planned dividends, around $500 million. First quarter fiscal 2026, ending December 31st. Consolidated revenues, expected between $6.3 billion and $6.8 billion. Homes closed, home building projected between 17,100 and 17,600 homes. Home sales gross margin, expected to be between 20% and 20.5%. Consolidated pretax profit margin, expected to be between 11.3% and 11.8%. Income tax rate, approximately 24.5%. Significant risk factors, affordability constraints and cautious consumer sentiment. These continue to impact new home demand. Mortgage interest rates. Fluctuations and high rates can affect buyer affordability and willingness to purchase. Incentive levels. Management anticipates incentive levels to remain elevated in fiscal 2026, impacting gross margins. Economic volatility and uncertainty. The broader economic environment presents ongoing challenges. Land costs, expected to continue increasing, requiring offsets from construction cost savings or pricing. Highlights: strong shareholder returns. D.R. Horton has delivered a compounded annual shareholder return of over 20% over the last 10 years. They generated $3.4 billion in operating cash flow in fiscal 2025 and returned $4.8 billion to shareholders. Industry-leading platform and scale. The company continues to leverage its scale and efficient operations to provide affordable homeownership. Improved cycle times. Decreased median cycle time from home start to home close by 2 weeks year-over-year, enabling more efficient inventory management. Strong lot position. Approximately 592,000 lots at year-end, providing flexibility. Financial strength. Low leverage, healthy liquidity, $6.6 billion consolidated, and disciplined capital allocation. Dividend growth. Declared a new quarterly dividend of 45 cents per share, marking the 12th consecutive year of dividend growth. Market share. Completed their 24th consecutive year as the largest builder in the United States. Lowlights. Sequential decrease in gross margin. The home sales gross profit margin decreased sequentially in Q4 2025 due to higher incentive costs and litigation costs. Elevated incentive levels. Management expects incentive levels to remain elevated in fiscal 2026, which can pressure margins. Choppy demand. New home demand is described as choppy and impacted by rate volatility and consumer sentiment. Impact of litigation costs. Higher than normal litigation costs contributed to the sequential decrease in gross margin in Q4. Key statements from management. Paul Romanowski, President and CEO. Our teams continue to respond with discipline during the fourth quarter, driving a 5% increase in net sales orders while carefully balancing pace, price, and incentives to meet demand. We remain focused on capital efficiency to generate strong operating cash flows and deliver compelling returns to our shareholders. We strive to offer our customers an attractive value proposition by providing quality homes at affordable price points. We will continue to tailor our product offerings, sales incentives, and number of homes in inventory based on demand in each of our markets to maximize returns. In closing, our results and position reflect our experienced teams, industry-leading market share, broad geographic footprint, and focus on delivering quality homes at affordable price points. Looking ahead, we have a positive outlook for the housing market over the medium to long term. Bill Wheat, Chief Financial Officer. Our cancellation rate for the quarter was 20%, up from 17% sequentially, and down from 21% in the prior year quarter. Our cancellation rate is in line with our historical average. Our consolidated leverage at fiscal year-end was 19.8%, and we plan to maintain our leverage around 20% over the long term. Based on our strong financial position and cash flow, our board declared a new quarterly dividend of 45 cents per share, a 13% annualized increase compared to the prior year, making fiscal 2026 our 12th consecutive year of dividend growth. Regarding Q1 gross margin guidance, that just reflects the environment we're in and the level of incentives that we're seeing, and our exit gross margin at the end of the quarter was a bit lower than we anticipated coming into the quarter. Mike Murray, Chief Operating Officer. Our starts were lower certainly in the quarter, and that was intentional as we look to get our inventory in line with where it is, also in response to our continued improvement in our cycle times. We're going to need to increase our starts as we go through the quarter and into the spring, but feel very good about our ability from a labor base and from our positioning of our communities and our lot supply to respond to the market as it comes at us. In summary, D.R. Horton delivered solid results in Q4 fiscal 2025, demonstrating resilience in a challenging market characterized by affordability constraints. The company is strategically balancing sales volume with pricing and incentives to meet demand, while maintaining a strong focus on capital efficiency and shareholder returns. Looking ahead to fiscal 2026, DHI anticipates continued revenue growth and home closings, supported by its expansive community count and disciplined operational approach, despite ongoing market uncertainties.